Hey there everyone, Thomas Wood here with Basecamp Trading, and today we're going to continue with the Intro to Trading series, and specifically we're going to be diving into what is leverage. So many people have heard the term leverage thrown around when trading, and they don't really understand what it does, and a lot of times people are actually afraid of using leverage. So that's because leverage can be a double-edged sword. We're using debt, borrowed capital, in order to undertake an investment or place a trade and increase our potential returns. Now, the reason it's a double-edged sword is because it can also increase our potential losses if the trade moves against us. So before we dive in here any deeper, make sure you hit that like button and subscribe if you haven't already done so you can stay up to date as we go through and do this entire series on intro to trading and building the foundation or the fundamentals of learning how to trade the markets. All right, so we're going to take an example here of Peloton. And let's say you hypothetically purchased 100 shares of Peloton down at the $20 level down here. And then as Peloton climbed, you ended up covering that 100 shares and you sold them at $40. So if you had done this, you would have put in $2,000 initially for your initial investment and then covered it and made $4,000 when you sold it. So you would have gotten back your entire $2,000 plus an additional $2,000, and you would have made what's considered a 100% return. Okay, so you would have doubled your money. Now let's talk about what leverage would do in this situation. So let's say we did not have the $2,000 available to place this trade, but let's say we had $100 or $1,000 available. And then we went to our broker and we said, okay, we want to use leverage to buy this. So we want to buy 100 shares, but all I have is this $1,000 in my account. So they may loan you that margin or loan you a margin, that amount of capital, the extra $1,000, so you can buy all 100 shares. So now you've put up $1,000 to buy a $2,000 position. And when this climbs and you covered at 40, you now made $4,000 on the trade, or you sold it for $4,000. So instead of having taken $2,000 and turned it into $4,000, you now took your $1,000 position plus $1,000 of borrowed money and turned it into $4,000, which means your return is 300% as opposed to 100%. Minus whatever the fees are associated with borrowing that extra $1,000 to put on the trade in the first place. Okay, because you have to pay interest, for example, when you're using leverage. So with that being said, it's a great tool to potentially amplify your returns on trades. Now, the double-edged sword, the reason that can strike both ways is because let's take this same trade and let's hypothetically say we bought at $20, and if we had put all $2,000 up ourselves, and then this market turned and went down to $10, so it decreased by 50%, we would still have $1,000 left over in our account, so we would have had a 50% loss. However, if we had used leverage and we had bought $2,000 worth of Peloton, and we only put up $1,000 and borrowed the other $1,000 on margin, then what would have happened is we would end up losing all $1,000 of our initial investment, and we just lost 100% of our initial or our account, even though the market only had a 50% drawdown. Because you have to, when you're using leverage, you're saying you're going to eat the gains or the losses associated with that position. All right. When you're borrowing that money, you're saying, okay, it's risk-free to you. You're going to get your interest, but I'm going to make all the profits or losses associated with the move. So you're responsible for understanding how it works. So it's a great tool, and we use it all the time in things like options, and especially with futures markets and Forex, because you need to be able to increase your position sizing. However, you want to be careful and be aware of what you're doing so you don't over leverage yourself and end up blowing up your account because you were putting on too large of a position without understanding how much you were actually putting in there, and a very small move in the market could actually wipe out your total investment. All right, so leverage is a great tool in moderation, but don't over leverage yourself when trading. All right, so that's a little bit about the fundamentals of what leverage is and how we use it. Make sure, once again, you like and subscribe if you haven't already done so. And until next time, everyone, happy trading.